Welcome to the Real Estate Things podcast. I'm your host, Dalton Elliott. I am joined today by Chris Wilhoit, Director of Operations at Lima One Capital. Chris, thank you for joining.
Absolutely. Thank you for having me.
For sure. So you and I go to really way back. I was a wee young little boy, just graduated from Furman, rocking the regalia today. You were one of the three people who actually interviewed me to come aboard. I think you refer to that day as the biggest mistake of your life, right? You said, let's bring this guy on, or maybe you were the third vote that just made the wise decision.
I tipped the scale positive.
Oh, you did?
Yeah. Oh, yeah. Yeah. Where would we be without the real state of things? So.
Oh, this is true. That's true. Good decision on you. You're wise. And just like you and I were catching up before this episode, I'm just going to ride your coattails. You're much smarter than me, so this is going to be easy. So I'm just going to do some learning here. Yeah, and you're going to do some teaching, and we're going to be good to go.
Yeah, so just a little introduction about myself maybe to start with.
Yes.
I've been with the company since 2013, shortly after the kind of the relocation from Atlanta to our Greenville offices. And when I joined, we were a very small, kind of startup-minded company of fewer than 10 people at that point in time. And since that time, I've held a bunch of roles in operations throughout the evolution of our operations team at Lima One, and helped spin off some of the groups, one of which Dalton is now the director of, and our sales groups over that period of time from 2013 to today. And then most notably in 2015, we saw a huge opportunity in the market for, call it ultra small balance. I like to call it mom and pop single family rental lending, because you had your B2Rs of the time, Colony American Finance, which has gone through several iterations of names, and other larger institutional-minded lenders really looking for large aggregators of single-family residential rental properties, of which there are only a couple, right? There are a handful of those types of large aggregators, which typically comprise, your kind of single borrower securitization market. And so we saw an opportunity where the majority of single-family residential rental properties owned in this country are owned by mom-and-pop investors, smaller investors who own between 1 to 10 properties. That's the vast majority of that. What comprises about 33% of the total real estate market held by investors. And that's that smaller group. And so it was really a segment that was completely missed by that focus on the large institutional investor. And so we started a program in 2015 with a lot of feedback from our current clients at the time who really had no access to permanent institutional grade capital for their single family residential investment properties. Other than going to smaller regional banks or trying to go agency financing, and there are issues going down each of those avenues. Agency financing really just isn't made for investors, and so you don't get the protections of your LLCs and the different types of liability protection from the ownership and the vesting of the property, since Fannie Mae requires that you vest in your personal name, and then regional banks are always going to tap you out at a certain point. And so that's where we really saw a huge potential for ultra small balance single family rental loans. And we started that in 2015. I helmed that particular department until 2020. Where we saw an opportunity to grow a little bit at Lima One, and took over director of operations, now under my purviews, consolidating all of our processing and our credit overlays for our different deal teams throughout the organization, along with technology initiatives. And we've consolidated and really created a corporate valuation strategy, which has helped us navigate some really turbulent waters over the last 2 years with the flood of traditional financing really taking up most of the appraisal purview out there in the marketplace. So long introduction for myself. turn it back to you, Dalton. Steer us where you want to go.
Yeah, no, good walk down memory lane, and you have quite the pedigree here. Yeah, when I got here, Rental 30 was like 2 months old, and yeah, learned a lot at the knee of Mr. Wilhoit. So it's been a fun ride. But you mentioned the valuations piece, and you know, you're a secretive fella, so I know you won't give away anything crazy. But yeah, like COVID threw a wrench in everything. But one thing that you had and have just an incredible housing market, and yeah, I sometimes forget about size and lose view of perspective, right? Like we are like at Lima One, top dog in the space, right? But whenever you back out and look at the whole mortgage industry, there are forward originators that do more in a month than we do in a year. So it's just different. So talk to me about like just that valuations piece, where it is now, and more importantly, like where's it heading? Like what's the future look like on the valuation side?
Yeah, that's a good question. So, you hit the nail on the head with the issue that really we and other competitors like ours, and really any small non-depository, even small depository institutions who are forward originators are going to run into in a market like what we had, was that there were only so many qualified licensed appraisers in the marketplace, period, right? And part of that, the problem statement is that as a field, it's a fairly old style of employment field where you have to do an apprenticeship for a certain amount of time, and some of these aging out appraisers in the marketplace really don't want to take on an apprentice and go through that hassle of the 5 or 7 years it takes to accrue the amount of appraisals under that leadership to become an appraisal themselves. And so what we had was a rapidly increasing volume of new home purchases and refinances requiring full appraisal reports in the space, along with our rapidly increasing investor base. And because of the market share that the traditional forward originators have with their AMCs, the appraisal management companies, we were struggling to get traction there, right? And so a lot of what we had to do was continuous curation of our appraisal management companies down to the county level, and really try to create some concentration with different AMCs at that type of small micro layer. So, and where we couldn't, we were able to pivot a little bit off of what your agency lenders can't do, and go try to find some direct engage appraisers who might want a more challenging appraisal assignment, or want to work something non-agency. Because the other problem statement that we ran into was that our appraisal requirements are more demanding of an appraiser's time, right? So they can do a 2 or 3 traditional conforming 1004 single family residential appraisal reports for every one new construction or subject to valuation or portfolio of 5 or 6 single family rental properties, right? Where sometimes there's going to be access issues into those properties because they're tenanted, not by the owner, right? And so just run into all types of problems, and all of that comes together into just a problem statement. We have to pay more attention down to the market level of our coverage, and so our timing to really consolidate that appraisal department was actually perfect for us, because what we saw once we did consolidate and bring on some technology to help us to actually manage these huge networks of vendors down to that level was our turn times spiked, right? Like everybody else's in the market, completely unacceptable turn times for us at the 20-day range were pretty standard. And that's just, one of the hallmarks of the business purpose lending space is quick closings, right? And so that's one of the things that we weren't able to compete on anymore. And so what we also saw was a pivot away from your traditional single family 1004, 1025, 1073, which requires an appraiser to actually go visit the property, make the inspection itself, and to then drive by and physically locate all of their comparables in their market. So there's been a pivot from that to what are traditionally called hybrid appraisal approaches, and they're not on a Fannie Mae form, and so typically not recognized by the agencies. But so these are kind of a product that's custom fit for a company like ours, where a third party other than the appraiser can make the inspection on the property, return that inspection report to the appraiser, who does their market research on the comps and does a traditional valuation on the sales approach for that property. But they don't have to go physically visit the property, right? So you think about some markets where that's really difficult, right? LA, Atlanta, large geographies that, if you want to go visit all of your properties, it might take you a whole day, right? Just to inspect and physically go locate all these properties. Whereas you hire somebody else to do it, and you can sit and do the research and really increase your throughput as an appraiser. And so that's one of the things that we did, and really the business purpose lending space as a whole pivoted towards that. And then we also saw some interesting movement away from the traditional appraisal. And so I think Fannie Mae and some of the agents, GSE agency, really recognized the problem of a diminishing population of licensed appraisers within their markets. And for a long time, they created a patch where a lot of refinances and new home purchases didn't require appraisals at all, part of the evolution of that too was they also spent a lot of time creating a hybrid form of their own. And so Fannie Mae actually now has a hybrid form that they'll recognize, which isn't in broad use around non-agency lenders like ourselves, but hopefully that gets some traction, and the whole market can pivot towards that hybrid kind of concept over time.
Yeah, so a lot going on driving the, I guess you could say, advances in the valuation space, but it seems like the chief driver is that you just have an aging appraiser population, and like you said, no real or at least the apprenticeship numbers aren't keeping up with the numbers of appraisers who are aging out, right?
Yeah, that's part of it. And then too, you just almost no market, right, or almost no supply demand chain can take a 200% year over year increase all of a sudden, right? And so that's part of the problem too. It's like you literally couldn't have projected that the volume would have been what it was over the last year and a half. And so even if you were to have projected that, is that a sustainable volume over duration that you really need to staff to as a, if you could conceptualize staffing a national appraiser, firm, would you have done that anyway, right? Because, even if it's 200% of volume based on the previous year, is that sustainable over a long enough duration? So really, I mean, that problem statement, I don't think would have been better even if we knew it was going to happen, because it wasn't going to always happen at 200% volume. So really, it's just part of it, I think, which is healthy, is that the real estate appraisal industry as a concept really hasn't been revisited probably since 2007, 2008 with Dodd-Frank, which required the AMCs and the different consolidation of the non-arm's length between a forward originator and the actual appraiser. And so since then, it really hasn't been a lot of shakeup there. And I think this is a healthy shakeup that's really caused by the stress of a supply and demand slope that they just couldn't keep up with, right? And it's created innovation. And innovation for us is good, because that means we can maintain the speed. And then it's also good for our investors because it decreases cost. Because an appraiser visiting all of these properties is expensive at their higher salary, right? And so it's much cheaper to send someone else, like a real estate agent or a broker, to those properties to make those inspections and return them. So I think it's a healthy amount of shakeup there, and I hope that continues to gain traction, specifically, Fannie Mae's hybrid form as that evolves and matures.
Yeah, you mentioned faster and less expensive, and so those are two legs of the triangle, and then you have quality as the other leg, right? On the faster, cheaper, quality side of it. So,
Sure.
not to, I mean, just asking, right? You mentioned faster, cheaper. Does quality suffer? Yeah, where's the quality piece fit in?
I think it can, right? So if you paint a very broad brush on the industry and you just, or on the entire market, right? The U.S. market, which is not a homogenous market by any means, right?
Right.
And just say I'm going to do hybrids everywhere all the time for all of my products, fix and flip, new construction, your bridge, permanent rental, regardless of the complexity of the assignment, you're going to suffer quality. Like there's just, there are situations in which an appraiser needs to visit the physical location of the property to really understand the subject's proximity to amenities and the neighborhood and different things that will impact the value, right? And so understanding the complexity of the assignment is a really crucial element to making sure that you don't lose quality while adopting something like a hybrid approach or a more innovative approach where it's going to be cheaper, faster, and they're not going to visit the physical property, right? So anytime you're doing new construction, I think it's typically a good idea to at least have that appraiser do drive-by. It's a more complex rehab project, where they're going to scrape to the foundation and rebuild. Always a good idea to have a physical inspection by the appraiser to make sure that they're understanding the theoretical subject to value of the property. But your median value single family residential rental properties, for the most part, I think it's a good approach that increases the throughput, decreases turn times, and allows us to get those valuations back quickly. Because apart from just a desire to move quickly, that really has been a linchpin of the business purpose lending space for so many years. Now it's really important to move quickly because rates are moving extremely quickly, right? It is an incredibly volatile interest rate environment. And so our ability to, project that interest rate movement is basically, it's not in our hands at this point, right? So the Fed is moving interest rates several times already this year. They will be again several more times this year. And we just don't know what that kind of volatility is going to look like. You've got, other international issues and concerns that are also putting pressure on that. And so, ability to execute quickly is paramount to our investors to make sure that the rate we quote them, at the date of their application is as close as possible to the rate we can close under. So,
yeah, that's fair. So, walk with me down the future lane. 5 years from now, are you able to put a finger on the pulse of what valuations look like in this space, in the BPL space?
Yeah, only in our space. So I would say, and really only for Lima One Capital. So I would, I'd like to take that concept of a hybrid and move it further along, specifically for Lima One Capital, so that we can create a concept of a hybrid that really doesn't require third-party engagement from third-party appraisers. And that's where I think the industry is moving. So without giving away too much of the secret sauce here, I think moving wholesale away from our reliance on third-party appraisers is really where we need to go as a company to ensure that we can have the quality of valuation that we want with the turn times that we need, and we're controlling the cost for our clients. So a couple of things that over the last couple of years have really allowed that to happen, right? So you've got an increasing quality of national data available, aggregated at your fingertips, right, all the time. So you've got all the same public data in most markets that any local appraiser, and MLS data that any local appraiser would be using at the click of a button, right? And so that's really what allows you to move away from relying on a third-party appraiser in their local market who has subscription to their MLS, and no one else has that, right? So, typically if you're, you work in Georgia as a licensed appraiser, there's no reason for you to have other MLS, right, outside of your local market. Whereas today you can subscribe and get, basically 97% coverage over the U.S. and get most MLS and public data. And so, that plus, just understanding our marketplace and using the data we've aggregated through our originations and time allows us to project that in the future we're going to move away from relying on third-party appraisers like that.
Yeah, what you're saying reminds me of the conversation I had with Gary Beasley, like CEO of Roofstock, brilliant human, and I picked his brain. I don't know what it was, 30 minutes, an hour after we finished recording the podcast, and just diving into the valuation side and what they're doing at Roofstock to, a similar pathway that we and others in the space are following. I really like asking questions. Like, you can't just look at the data and go, all right, is it in a good school district?
Right.
That's very different from being, is it literally across the street from the great school in the school district? Power lines, like all these things that he's like, yeah, you just don't need to, in a lot of places, you don't need to actually send somebody out there to answer those questions. Like, it's so, like, the data piece is, it becomes, what do you want? Like, what is going to change the value at all, have any impact on it?
Right.
Where can we find that data source? Plug it in. Here's how we feel about, yes, no, to what degree, and then you have your model for valuation. So it's that's probably the most oversimplified rundown that one could possibly give. But again, I'm a simple boy. You're the mad scientist over here, Chris. Well, so you mentioned good.
I was just going to say where I completely agree with that assessment is that you're always going to need an expert to say, to look at the physical location of the property. And that's another thing, like, apart from, this is kind of a data element, but apart from just data, you've got better mapping of these properties, right? You've got Google Earth, and you can zoom down to the property's location, find those power lines, find those things without physically being at the property. Right. You can, if you do still want an inspection on the property because your risk appetite says that these properties in these markets still probably need a physical inspection by a third party, there are great apps and services that can return that kind of inspection of that property for you, geotagged with the dates, and you can walk people through the actual photos of their property. And so, you can get pretty secure that you're getting a full view of that property without ever having to physically be anywhere near it. So yeah, absolutely.
Yeah, I want to bring back something you mentioned, rental rates, right? And not in terms of mortgage rates, but for some reason I'm blanking on the
rental.
All right,
the market.
Yeah, I'm going to jot this down. This is the first time, Chris, and of course it's with you. First time I've had a goof and just couldn't think of what I wanted to say. Rental income. No, well, not income, but how rents have skyrocketed.
Yeah, got it.
I'm struggling with this. 23 minutes, Dalton. We'll have to cut that. Look at what you do. You make me so nervous, Chris. All right, I'll tee us up for this.
Yeah, I think they took single-family rental rent growth, just single-family rent growth.
Single-family rent growth. Got it. All right, one thing I want to come back to is single-family rent growth.
Yeah.
Just as up and to the right, I don't know which way if it's going to be mirrored or not, but whatever up and to the right is
19.3% single family rent growth year over year as measured February 2022 to 21. So
how crazy. So we have a housing supply issue, which was present before COVID, exacerbated by COVID.
Sure.
That's going to take years to get from where we were post-recession, like post-Great Recession, which was underbuilding, overbuilding before, underbuilding.
Yeah.
Pre-COVID, we weren't really even caught up at the pace. COVID threw a wrench in it. So now we've fallen even further behind. So then that drives more of an increase for the rental side of the fence, and rental rates Yeah, single family rent growth has just been insane. So
Right.
is this like, what does this look like the back part of this year? Like, do we in February next year, are we going to look and see kind of a similar metric year over year compared to the February stat you just threw out? Where's this going?
Yeah, no, so my crystal ball, I don't think so. And I don't think that's sustainable for renters, right?
Right.
So, I think there's several factors all coming together that have really influenced that astronomical growth of single family rent in the U.S. And it's truly at the single family level. And some of it was just, on the back of the most stringent COVID restrictions. People realized they wanted to move their families out of high rises or condos or places with no green space or yards and into single family residential properties. Increase of remote work allowed that to happen. And so you had this large diaspora of people moving from their physical location, which they used to be required to be at because of their job or their work or their specialty, into now being able to be location agnostic because they can work remotely or maybe they're even going to relocate, right? So you have that also, and that what they call the Great Resignation. So several factors all contributing to movement of people around the U.S. And then what those people came up against was exactly what you said. New housing starts have not kept up with the demand growth. And then when that demand growth skyrockets overnight in a lot of these areas, you have house price appreciation that has just become outrageous, right? So in the 20% in a lot of markets, home price appreciation. And so when you combine home price appreciation with people moving from, areas where the cost of living is much higher to areas where the cost of living is much lower, they bring, that capital with them, and they're going to increase the cost of the properties because they really don't care what the cost is in that market. They have the cash, they're gonna pay for the property in cash, and that creates a very competitive market where your HPA is going to heat up really quickly, right? You have a quarter of all properties in the U.S. selling for cash over a year-long period, right? It's just, you've never seen anything like it, right? And so what the Fed is doing to kind of ease that burning hot home price appreciation is increasing the prime interest rates, right? But there's an immediate shock that actually makes affordability, where home price appreciation isn't going to drop overnight, even worse, right? So your first time home buyers, new entrants to the market, or even people who've just lived in one market and now they're ready to buy a home, been renting for X number of years, and they've saved up that down payment. Well, HPA makes that down payment requirement much higher, and now their DTI is all out of whack because along with that higher cost of property, you've got interest rates that are up 1.5, almost 2 points over that same period. And so there's got to be some balancing, right? So typically when your interest rates go up, your HPA should kind of flatten out a little bit and really start to cool off. And that's the basic premise here of what we're trying to accomplish, or what the Fed's trying to accomplish with the interest rate increase. But there's going to be a period where that's going to create even more out of whack, new owner or first time home buyer affordability, and that's a huge problem, and that's a problem, honestly, that we've tried to help tackle on the new construction side, right? Like, our new construction lending has just skyrocketed, and that's because there's a historically low inventory, right? So it's the lowest inventory for housing in something like 45 years, right, across the U.S. And so it's just not keeping up with demand, and so you have to start creating incentive for new builds, and that's also where you see, there are a lot of individuals who are trying to take advantage of that rent growth and the HPA, and there's a lot of build to rent happening, right? So instead of building new high-rise developments, a lot of these larger developers are going out and building scattered site, single family residential contiguous build to rent developments, right? Where you can place tenants within that community. And for all intents and purposes for the property management, it looks and feels a lot like what an apartment complex would look and feel like for them as a manager, right? It's all contiguous, combined single-family residential property, but it's just keeping up with the demand of where renters want to place themselves and their families today.
Yeah, it is. Wow, that's an interesting read, and I'm gonna have you back on here for like a Thanksgiving special, and we're gonna hold your feet to the fire. We're gonna play that clip and see how it stacks up.
Yeah, I hope it does stack up, right? Because at a certain point, I think the concentration of investor-owned properties increasing about 5% year over year from about 28% to 33, 32% over that same period of time. That shows you a little bit of that cash. And then it also shows, some of the build to rent inventory, and then just, investors going and snapping up single family rental properties, take advantage of that 19% rent growth. And so where that's healthy for Lima One Capital, I also think, that we need to also balance that out by increasing the accessibility of new construction financing for our good builders. And that's exactly what we're trying to do on that side of the house as well.
Very well put, Mr. Wilhoit. Professor Wilhoit. That's going to be your name on this podcast. I'm going to tell marketing. We'll get Professor Christopher T. Wilhoit. Professor, thank you so much for joining us and teaching this class today. Always learn something when I'm around you. Thank you very much, my good friend.
Thank you, Dalton. Appreciate it.
Hey, thanks everybody for listening. Take care.